Private equity firms are professional buyers. If you don't control the process, they will end up doing that for you. Today we're going to talk about how founders should evaluate private equity offers, not emotionally, not by just headline valuation, but strategically and for long-term gains. By the end of this video, you should learn how to evaluate private equity offers, understand how to stay in control throughout the process, and eventually learn how to maximize the long-term value you're going to get from this transaction. I work closely with business owners and investors across the GCC on M&A transactions, and what I've seen is founders accepting a private equity offer that they end up regretting. Maybe not immediately, but in a 6 month or 12-month span. What we're trying to do today is make sure that doesn't happen to you. I've also seen founders slow down the process, ask the right questions, take advice from advisors, and then eventually walk away with the best outcome possible, even if at a lower initial valuation. It's the long-term value that we're looking for, and that's how we're going to help you get there. Before moving forward with our topic, I want to know from you, are you currently speaking to private equity firms or plan to in the next 12 to 24 months? If that's the case, leave a comment and we can take it from there. When evaluating multiple private equity offers, there's multiple things we need to look at, multiple aspects we want to look at, not just the headline numbers. Headline valuation is just one aspect to look at. What we need to do to get the better overall transaction and overall deal for you is we need to look at control rights, earnouts, governance, exit timelines. It's important that we look at all aspects of these offers so that we know we're getting what's best for you. Many founders we've found focus on the headline number. Most private equity firms focus on the structure. It's very critical that when you receive private equity firms' offers, that you understand the right questions to ask, and basically you end up interviewing them, not the other way around. In this way, you end up taking control over the process, and you control who enters with you as a partner in the company or ends up buying a major share of your company. Some of the questions which we find useful are: what's your hold period? Also, how involved are you in the operations of the business? What would you do if growth slows? And finally, who replaces management if targets aren't hit? While reviewing private equity offers, you need to assess their capabilities and track record. Some of the key areas to look at is sector experience, value creation history, not just exits, but also the value they created for their portfolio companies, and regional operational understanding. Some PE firms may have been successful in North America or in Europe, but may not have specific regional experience. Finally, another area we look at, or you should look at, is capital structure. If they can't clearly explain how they create value, you have your answer. One of the aspects we look at very closely is the PE firm buying a minority share or are they buying a controlling share? So what does controlling share really mean? Controlling share means they have enough votes on the board and they have veto rights and they can affect budgets. So usually that means they either have more than 51%, in some cases more than 76%, which gives them an overall absolute majority and control. Why do some PE firms buy minority shares or minority transactions? Because for them, they want to keep the existing management in place, they want management to continue to grow, and they want to keep what was working to continue to work. So they would rather come in with a minority share, inject capital, keep the existing plans, keep existing management, and allow them to grow with this new capital injection and plans for the next 5 to 8 years. Some of the risks that founders usually overlook is governance. The burden basically of having a minority or majority shareholder with you on the board, where a lot of decisions need to be now taken to the board versus when you were running the show yourself. This could create a slowdown in process. This could create complexity and a lot of times conflict if there is not enough alignment on goals and short-term plans. This could be a specific nuance and a specific issue for family businesses that are used to running the business completely within the family. When a third party, what we've seen in the past, when a third party PE firm comes, that could create a lot more friction, could slow down the process, also lead to conflict. And this is why it's very important, while reviewing the transaction, understanding the deal, understanding what it means, what level of control are they going to receive, what does that mean from a governance perspective, what does that mean from a voting rights perspective, and ultimately how much integration, how well aligned are you with this incoming firm. Preventing retrades. So by retrades we mean when a PE firm or any firm that's presenting an offer goes back and tries to renegotiate and tries to lower the price after initial offer. We need to understand the reasons why this happens, and we need to think about how to avoid this. So the last thing you want to do as a founder is to get into a lengthy due diligence process after reviewing all the different offers you have in hand, and only to realize after that due diligence process that the selected bidder or selected offer is now, that company is now trying to renegotiate, lower prices, change terms, and that leaves you in a very bad position. Could also mean that some of the offers that were on the table are no longer there. So why do these things happen? One of the main reasons is the LOIs were not very clear or were quite vague. So one of the things we want to make sure is that we review these LOIs. By LOIs, I mean letter of intents. Make sure that everything is clear in them. We make sure that we understand the terms and what allows for a change in valuation and what doesn't. This gives us opportunity to make sure that we are aligned what the next steps would be during due diligence and after due diligence while drafting SPAs. The other area which is very clear, very important so that we don't have these retrades or renegotiations, ensuring that we have clean financials. Ensuring that the financials heading into the process are clean, are very clear, and that reconcile properly and that can be understood by a due diligence team, and that we don't end up with a lot of questions and a lot of adjustments post due diligence. The best deals don't fall apart in diligence. They fall apart because they were structured improperly to begin with. So finally, we're going to talk about how do we select the best fit PE partner. What do we look at? What should you look at as a founder? And what's the process you should go through? So the best fit PE partner should be someone with strategic alignment to begin with. So they see the company and the vision for the company similar to where you see it in a 5-year or 7-year horizon. The other part is cultural fit. So you can see how they work with their current partners or their current portfolio companies. Are they active, or do they intervene in areas which you think should be left to management? Is it clear how governance works for them? What do they expect from management going forward? These are all areas that you need to be looking at. And other areas like exit vision. So when do they want to exit their position? And are we looking at a full exit for you and the partner, say in an 8-year period? Or are we looking at a partial exit for the PE firm alone? It's very important that this is discussed and agreed upon early on in the process. And finally, one area which we see a lot of people overlooking is risk appetite. So does this firm have the same risk appetite that you as a founder have? A lot of times we find that founders, entrepreneurial by nature, might have a higher risk appetite than financial investors like PE firms. It's very important that these areas are aligned so that any investment going forward, post-deal transactions are clear, that the value that is going to bring to the company is clear, and that you are both aligned on the levels of risks that the company should take to achieve its goals. I'll end with what I always tell our partners and our clients. The best private equity partner is not the one who pays the most, it's the one that breaks the business the least. If you're considering private equity, preparation is leverage. The earlier you structure the process, the more control you keep. To explore advisory support, insights, and active opportunities, you can visit our website. It's in the link below. Everything in our website is built specifically for founders navigating M&A and private equity in the GCC. If you want our private equity offer, comparison checklist, the exact framework we use internally, comment with PE checklist and I'll send it to you. Subscribe for more M&A Masterclass moments.